Okay, thank you all for joining us for today's episode of the On the Mark Financial Forum and podcast. We are excited to bring this topic to you today about how to succeed as a first-time homebuyer. And I'm joined today by my business partner of 16 years, Gabi Foyer, the one and only. Gabi, nice to see you.
Hello. Thank you for having me.
Absolutely. Absolutely. I think we have a lot of great insight to share with people. And our group today is pretty diverse as far as it being a mix of clients, real estate professionals, financial advisors, and business managers. So I think we're going to have a pretty wide range of comments to share from different perspectives. So, and for those of you who are following us on social, if you post and share the content about this session today and you tag us. We're at the Bridge Loan Guy on Instagram, or you can find us on LinkedIn as well by my name. We will enter you to win a $25 gift card to Amazon. We'll do a raffle in a couple of weeks and choose the winner. And we would love to see you share this with others because we think the content is definitely valuable. And for those of you watching afterwards, you can do the same. So we encourage you to share this with your network as much as you can. So we're gonna dive right in here, Gabi. So I think it's important to give people some context of what's happening in the market and how to navigate those current circumstances that we're in. And we're in kind of a weird anomaly of a market where the usual rules of engagement aren't really applying. So why don't I turn it over to you, Gabi? You can kind of talk a little bit about like what's happening with inventory and just the market in general.
Sure. Yeah. I mean, I think that, like you're saying, it's kind of a weird market where it's not one way, either a strong buyer's market, strong seller's market. We're kind of in an in-between stage where, we're definitely seeing low inventory. And you've got a lot of current homeowners have, incredibly low interest rates from when they purchased, and they're pretty iffy about selling and moving on because they don't want to give up that low interest rate. So I think that's a big sticking point right now for inventory. Um, the population growth is also outpacing the amount of new properties that have been built over the last several years. So you've got constraint in inventory over there, and the builders are still having trouble building properties. We're still having, from COVID, we're still having supply chain issues. We're still, concerns about where the market's going to be headed and what type of properties they should be building, where the most demand is. So we're still, the builders are still not building to the appetite of what people may need or what we're seeing right now. So I think that's really, constraining the inventory that we have. At the
Yeah.
same time, I think that there is buyer demand out there, right? There are people who always need to move. There are people who are switching jobs. There are people who are moving different states and things like that, or looking for larger houses. Their families are growing and things like that. So, there still is a strong buyer demand out there, but I don't think there's enough of a demand like we saw, let's say 2 years ago, 3 years ago, where you're having, 20 or 30 offers at an open house. You will see some bidding wars, but I think that you're seeing, less than what we had in the last few years.
Right. Yeah, I would agree. And I think one of the interesting stats that I read recently, I actually just got an email about it this morning, was that building is at a 3-year low because there was
Wow.
so much building during the pandemic because the demand was so incredibly strong. Then you run into the builders are running into these supply chain issues where they can't get the materials to build. I had that experience when I was building, converting a garage into a additional dwelling unit, an ADU, and the gas meters were out of stock. So we couldn't get a gas meter installed, couldn't put a tenant in that property. So I've experienced these things firsthand. And I think builders are a little unsure as to where the market's headed over the next 3, 4, 5 years. When they get nervous, then they don't build as much because they're not sure if the demand will still be there. I think it will be, but especially if interest rates come down. But it's kind of an interesting market. And normally when you see interest rates go up, that usually slows down demand. And like you said, Gabi, we're probably seeing less bids on each property overall, but there's still multiple bids on almost every property. So you're still in some version of a bidding war. It may just be that prices aren't going, 25% over asking because one person goes absolutely bonkers with their offer and pushes the price up so high that nobody else would even, want to try to compete with that.
I think it's also important to note that, this is very region by region or even neighborhood by neighborhood. So you may have, one state is experiencing one thing, another state is experiencing another, or one neighborhood is experiencing something. So it's really important to also have a good real estate agent who can kind of help you out and tell you about what's going on in your local market, because I think we are seeing a lot different. I think the trend is going to be the same nationwide. But I've definitely seen some major differences between neighborhood to neighborhood.
Yeah, that's a really good point. And it's true because we're doing business in 21 states right now, and we're seeing different things happen in different ones. Obviously, we have the ones that we focus on primarily in the Northeast and the Southwest, but we're seeing different things play out in different markets. But as you have low inventory and you have relatively high demand, that means prices are staying on the higher end. So the question is, what's going to happen from here? And just for context, we're recording this session in September of 2023. So if anybody's watching this a year or two from now, they'll understand the context that we're in now. But we're in a higher rate environment. That's no surprise. The media loves to talk about that on a daily basis, that, interest rates are up this week. And the average went from like 7.12 to 7.13. And that's supposedly newsworthy. But we are seeing that, rates are obviously higher than they've been in several years. And that's keeping some buyers out of the market, but certainly not all. And I think people have kind of adjusted to the fact that this is the reality if they want to buy now, that interest rates are what they are. However, interest rates are likely, as inflation cools off, and hopefully some of the things that the Fed is doing and has been doing over the last year or so actually take the intended effect of slowing down the economy and slowing down inflation, we should see interest rates moderate at some point. Now, some people are saying we're in a period of higher for longer right now, meaning that the interest rates might stay at the higher end of, roughly where they are now for a longer period of time. They're not just going to fall off a cliff, but that's kind of to be expected. Rates never just drop, 2% in one day. It's always a gradual thing. But my personal take is that I think we're going to see over the next 2 years, we're going to see rates moderate probably somewhere in between where they are now and where they were at their lowest point. I don't think we're going to see rates go quite, down into the 2s and 3s again, because that took basically the world shutting down for that to happen, and the government buying bonds and all sorts of things that are, just not happening anymore. But the question is, what happens when the rates go down? Because you have all these buyers that are sitting on the sidelines doing nothing, waiting for interest rates to come down because they think that that's the right time to buy. But the problem is, when those rates go down, you're going to have an influx of these buyers. And that influx of buyers, in my opinion, is going to be, you're going to have more buyers entering the market than sellers, which is going to, again, supply and demand, still relatively low inventory. Now, all of a sudden, all these buyers have been sitting on the fence, jump back in, and now you're back to multiple bids on properties, and therefore prices going higher. So I personally think, and I'm putting my money where my mouth is, because I'm in contract to buy a property right now because I really believe in this, is that we are likely to see higher prices once those interest rates drop, because I think we'll still have the supply issues to a degree, because builders can't build a house in a week, right? It takes months. You have to plan, you have to have the plans, you have to have permits, you have to physically build the house, you have to have all the materials, and wait for the city to issue a certificate of occupancy, whatever it is. It's a long process. So they're always delayed, and they're always looking for signs in the market before they really jump back into building at full capacity. And that's just not happening. It's not going to happen quickly enough to offset the influx of buyers that are going to be coming into the market. So I really think there's an opportunity for people, first-time home buyers in particular, and we'll talk about why. But I think there's a real opportunity for people to jump into the market now. Whereas if they wait until that interest rate correction happens, they're likely to be paying higher prices at that point. And we won't rehash all the details, but Gabby and I, we did a session that you can watch or listen to on the podcast, where we compared what it was like to buy in the current market versus what it was a couple of years ago, where there was a bit of a frenzy. And we basically looked at some numbers to prove that the price matters a lot more than the interest rate. And especially in an environment where interest rates are likely to come down over the next couple of years or so, even if it takes 3 years, whatever it may be, if you're able to get into the market now at a lower price than you would have a couple of years ago, or maybe 1 or 2 years from now, and then refinance that loan at some point down the road, those are the people that really benefit. So we had a quick question. What's the podcast called? It's called On the Mark. And you can find it in any major streaming platform. So if you search for my name and On the Mark, it should come up for you. So definitely check that out. And so Gabi wanted to talk.
To jump in also, I just want to say that, interest rates are definitely higher than they have been over the last several years, but they're not bad. And I think that's kind of sticking point where a lot of people think that interest rates right now are, they're so high, they're so bad. Rates in the early 80s, obviously we're getting up to 17, 18%, but even rates in the 7% in the 90s, early 2000s, that was average. So it seems like we were, it's not like you're getting a bad deal by purchasing now and having these higher interest rates. As obviously you've mentioned, rates are going to come down, but even at the current interest rates, I think it's still a fairly decent rate from what you've seen historically over the last, let's say 30, 40 years, looking at the long term, not just looking at the last 5 years, 6 years, something like that.
Right. Yeah, we're all a little we're
a little jaded,
a little skewed. Yeah,
yeah,
exactly. We've enjoyed low interest rates for a very long time. I mean, I've been in the industry 21 years. The highest I had seen in interest rates before this recent rise was about 6.5, and that was 21 years ago. Early 2000s, and they were higher right before then. So I came into the business on a downward trajectory for interest rates. But I think it creates an opportunity, because with real estate, I mean, you look at I saw a video recently about the those interest rates you were talking about, Gabi. It was a news series about, interest rates just fell from 18 to 17.5, and they were interviewing people who are considering buying a home and saying, do you think it's a good time to buy a home? And there were, like the same exact issues that we're hearing people talk about now. Just there was a 1 before the 7 in the interest rate back then. But if you look read in between the lines of those videos, like, let's think back. Let's say you were a buyer back in that time and you bought that property despite the 17, 18% interest rates. But obviously this is an extreme example. You probably bought that house for $50,000 maybe. What's that home worth now? Right? Millions, probably, at least, if not more, depending on where it is. So the beauty of real estate is that if you hold it long enough and you can stomach the payments and the interest rates and all that, it's not that you can't lose. Real estate is like any investment. You can, quote unquote, lose if you can't play your cards right. But there's a high likelihood that if you hold a property long enough to offset some of those market fluctuations, you're going to come out stronger. I don't think anybody who decided to buy when the interest rates were 17 or 18% in the 80s, if they still own that home, I don't think they care what interest rate they paid back then. Right. So for context, I think that's important for people to understand, is that values go up and down over time, but that's only if you're looking at it within a tight window. With real estate, it's a long game, in my opinion. It's not something that you make money off of immediately or off of a short-term market fluctuation. It's something that if you hold on to it long enough, you'll see the long-term benefits of that. So just for context. So I want to shift, Gabi, the conversation to like where the opportunities are in the market right now, specifically for first-time buyers, they don't have this one common issue that existing homeowners have. Is that I'm going to tee you up for that one, let you
Yeah.
finish that one
It's
up.
it's something that we mentioned before. They don't have that lower interest rate that I think that they're, scared to get rid of, right? A current homeowner with a 3% interest rate, they don't want to give it up. They feel like they're going to be losing too much. And we've talked about why that's also a kind of not the greatest way for them to be thinking about it. But they have a 3% interest rate, a 4%, whatever it is. They're scared. They don't want to move to a 6, 7, 7.5% interest rate. If you're a first-time home buyer, you don't have to worry about that because you don't have a current interest rate. You just have your rent payments. That's most likely has been going up over, the last couple of years as people are scared to buy. Obviously, rents have increased as well. So you don't have that same issue. You don't have that fear. You can jump into the market kind of unattached to that current low interest rate.
Yeah, exactly. And that can be an advantage for people because, they can go in with an open mind, so to speak, right? They don't have that concern about giving up whatever they're giving up. Your interest rate on rent is infinite, right?
Right.
It's a lot higher than whatever the interest rates are going because you're not getting any equity and you're not really you're just throwing money out the window as opposed to putting it towards something that will grow in value over time. I think also with the current market conditions, being that maybe there's less bids on each property. And again, this is regional or neighborhood specific, but I don't think I think it's a safe thing to say that buyers aren't going to be competing with quite as many offers as they would have a year or two ago. So you may not have to bid way over asking, depending on the pricing strategy. You never know. Some agents intentionally price low to create a bidding war, and others will price it more reasonably and try to get something in it at asking. But in general, in a larger scale, I would say people aren't having to bid 20-25% over asking to win a bidding war or to get an accepted offer. So I think that's something, again, we talked about how price matters more than interest rate. I think now is a window of opportunity to be able to take advantage of that. And similarly, in environments like this, sometimes you see sellers that are willing to give concessions. So they might be willing to cover closing costs or pay for something called a buy down, which we'll talk about in a little bit more detail, or maybe help you buy points to get your interest rate down. Or, there's lots of different things that you might be able to get a seller to concede on, whether it be, something on the inspection. I mean, it could be any number of things. But in general, I think sellers are a little more amenable to doing things because they aren't just going to say, well, I have 30 other offers, and 10 of them are all cash. So if you ask me for $5 to repair something on the inspection, I'm going to just move on to the next buyer. I don't think they have that same level of comfort. So sometimes you can, as a buyer, you can, try to take advantage of that circumstance. Whereas 2 years ago, if you asked for anything, a contingency or credit towards repairs, anything, you were done, you were out. And because the sellers had so many different people to choose from. But I think also, Gabby, I want to turn the conversation to interest rates because, for people who are able to buy at a reasonable price now, prices are still relatively high, but let's just say a reasonable price, whatever that means, it's relative. But interest rates are expected to decline, like that could be an advantage for them.
Yeah, you always have that option. It's kind of cheesy, but we always say, you're marrying the price, but you're dating the rate, something like that. And the purchase price is what's going to last for the entire time you're in the property, right? From the day you buy the property until the moment you sell the property, the purchase price is always going to be there, right? And that's how you're going to make your money. That's how you're going to lose your money. Whatever it's going to be, it's going to be based on the purchase price. The interest rate is temporary, right? Interest rates right now, when you get your first mortgage, that's going to be your current interest rate. But if in 2 years from now rates drop, you can always refinance that loan. And I know a lot of people, may know what that is, but if you don't, you're getting a totally brand new loan with whatever the current lower interest rates are at that time. So you can wait, if in 2 years from now rates drop to 5%, you can get a new loan in 2 years from now at 5%. You're able to just reset the whole thing. And now it's as if you bought in an environment where rates are at 5%. That lasting effect of that high interest rate is done
Right.
at that,
And
at that
you
2 year mark.
and you get the best of both worlds because
And
now
you get
you
right, you
bought at a
got the
lower
lower
price,
price.
right? Which means you have less debt, right? You have a lower mortgage amount than you would have if you put down, 20% on $1 million purchase. You have an $800,000 loan. And if you put down 20% on $1,250,000, if the prices were 25% higher, which they may have been in some markets, you're looking at $1 million debt. So just looking at the amount of debt outstanding is that kind of puts things into perspective a little bit. But if you're able to get that lower mortgage balance because you paid less for the property and you're able to get that lower interest rate eventually, it may not be right away, so you have to make sure you can stomach the payments in the meantime, but that's just going to make things even easier once those rates come down. And they're widely expected. We can't say exactly what's going to happen or when, but it's pretty much a unanimous thing within most economic circles that interest rates are likely to come down from where they are now. Who knows exactly where? Hopefully 5s, 4s would be great. It'd be good for everybody on this call, I'm sure, to have interest rates go back down. But I think,
but again, when they do go down, all the new buyers are going to come out there, right? And everyone's gonna be like, oh, now's the time to buy. And that's what's going to push prices up again, because now you're battling against so many more people. And like we said, there's still those inventory constraints. So it's better to purchase when the interest rates are higher because you can refinance later on and you're not competing against all those other people. So
yeah,
it's a good hack to get in now when you don't have to battle through everybody else.
Exactly. And I refer to it as going against the grain. That's where people make money in real estate. You buy when everyone else is panicking and trying to sell. I mean, granted, we're not in that type of environment, but there's, different levels in between of a panic buyer's market and a panic seller's market. We're somewhere in between that. But when you go against the grain and you have all, like, for example, all these people that don't want to buy because interest rates are high, and you are the one that buys in that market, and then you try to sell when everyone's trying to buy, right? That's when you create a spread of what is now equity for you to be able to take advantage of. And I think if you look at any real estate investor, what's your strategy? You buy low, you sell high. Prices are low when, in some cases, when interest rates are high, right? So it's not the ideal time from a monthly payment perspective, but the price matters more than the interest rate, partly because you can refinance and partly because you get the properties for less money in general. So going
just
also, where the magic happens.
Agreed. Yeah. And I think you just touched upon something which is one of your favorite topics, I know, is investors and buying investment properties. A lot of people live maybe in a neighborhood right now, or in a city or in a state where maybe things are too expensive to purchase. Even still, with the constraint in inventory, you can always purchase investment properties now, which is a great time to do it. And rents are usually commensurate with the higher interest rates. So interest rates may be higher, but you're going to collect higher rent right now as well. And you still have that refinance opportunity later on when rents drop. So you can always, move into purchasing investment properties, maybe out of state or in a different area than where you're looking, to kind of take advantage of the current markets.
Yeah, and I think oftentimes, especially first-time home buyers, they're hyper focused on buying their first property as a primary residence, not realizing they don't have to do that. And it's actually, and we're not going to get into this in too much detail, but it's actually easier to qualify for an investment property loan as long as you have enough of a down payment to get there. They do require larger down payments, but there are programs out there where you don't have to show enough income to support the mortgage on your own. They're based on cash flow of the building exclusively. And there's some really creative loans for investors that don't apply to owner occupants because of the regulatory environment around owner occupied properties that's different for investors. So I think oftentimes first-time buyers in particular don't think about buying investment properties, or they're waiting until they're able to buy a primary residence, which may be a much higher price point than where they might be able to get an investment property that's maybe not in their ideal neighborhood, but they're not going to live there anyway. So if you get good rents, it can be a really great opportunity to create that wealth by starting the purchase earlier than they would. Maybe it's years earlier than they would be able to if they were looking at a primary residence in their ideal neighborhood. And we've helped clients successfully navigate that pretty regularly, and be able to buy an investment property so they build the equity that they can then utilize to buy their primary residence. So it's a little bit out of sequence to where most people think. Everybody thinks first time purchase has to be your primary residence, but it really doesn't. But I want to talk now about what first time buyers in particular can do to put themselves in the best possible position to be successful in the current market. That's the primary focus of our talk today, even though the context piece is really important. And with knowledge comes power. So I think the big overlying idea here is that you have to know what you're doing. Don't go into it without, the base knowledge of different aspects of it. So first and foremost, you have to build a good team around you. And as a first-time buyer, there's a lot you won't know, right? You haven't been through it before. You can rely on your parents or whoever who will tell you what it was like when they bought for the first time, but that was probably many years ago, or friends. But everyone's experience is different, and every market is different. So you want to make sure that you educate yourself and understand how to navigate this market, and no one can help you better than people that do this for a living every single day. So that's a great agent. I see a few of them on the call today. A great lender. I see two of them on the screen right now. And if you're in an attorney state, then you need a great attorney as well. But you need people who are willing to educate you and to spend time and effort, to not just toss you aside and say, oh, you have too many questions, I'm too busy for you. And that's something we really pride ourselves on, is spending a lot of time with people. We provide a lot of resources, whether it be this type of session, the podcast. We have a buyer's guide that we give out to people for free, that agents can give out to their clients, and clients can request on our website, markmyman.com, free copy of our buyer's guide to just educate people on a bunch of different important topics. Because the more you know going into the process, the more confident you'll be in the decisions. And sometimes decisions need to be made fast. Right? You walk into a property, for example, you might spend 20 minutes in there and then decide if you're going to buy $1 million home after spending 20 minutes in it. Like, that's just the nature of real estate. It sounds crazy, but that's how it works. You go to one open house, now all of a sudden they're reviewing offers. You got to put an offer, and you got to decide whether your 20-minute experience was worth $1 million or not. So I think, and that's something that your advisory team can help you with. But one of the most important things is understanding the market. So I think buyers oftentimes, don't go to open houses, don't go to see things until they feel like they're ready to buy. But I think, and this is something that I did when I first, my wife and I first moved to New York, and we were looking to buy our first place. I was probably 6 to 12 months off, but I spent some of my weekends, not all, but some of my weekends just going to open houses so I could get a sense of the market. And then when I was ready to buy, as soon as I walked into a property, I could pretty much tell with, interacting with my agent as well, if a property was underpriced, overpriced, if it was a good deal, if it, and just had a sense of it. And I felt very confident in the decisions that I made because of that time I spent to review neighborhoods and prices and things like that. I'm a very analytical person in general, so that was right up my alley. But I had context because I spent the time to do it. And you also need to know, like, what's a normal, like, what does the process look like? Because it's different. So like, we have clients that, they grew up in California, and now they're buying in New York because they live there now, and the process is completely different. The players are different. There's no escrow companies in New York. You have escrow companies in California. There's no attorneys in California, but you have attorneys involved in New York. So there's just completely different process, and you really have to like understand how the whole flow of a transaction works. And that's something that a good lender and an agent and possibly an attorney can help you understand. It's just the rules of engagement are important. And budgeting and priorities, Gabby, maybe I'll turn this one over to you to kind of talk about like how to get confident in the numbers.
Sure. So I think, priorities are always a difficult one. There's always a question of what do you need? What do you want? What location, and that kind of varies. What location are you looking at? How many bedrooms and bathrooms do you want? Even property type, in a lot of obviously states, there's, single family houses, there's multifamily houses, there's condos. If you're in New York, there's co-ops. There's a lot of different types of properties there, and people have different comforts in terms of the type of property that they're looking for, and obviously price range. And that kind of takes us to what your monthly budget is. And we can obviously work with you and work with the buyer to figure out what they're able to get qualified for. We need to know what their income is like, their liabilities, things like that. And you can also work with a financial advisor, and a financial advisor can really help you looking at your priorities, looking at your income, looking at your assets and liabilities, and work with you to define exactly what your monthly budget should be so that you can stick in that range. A lot of people, they try to buy a property and they're not 100% sure, or they'll call me and they'll say, what should my monthly budget be, or what should I be asking? And I can tell them what they're qualified for, but might not be the same thing as what their budget should be. Are they saving enough for retirement, or are they using all of their savings as a down payment in order to get what they qualify for? So sometimes bringing another expert like a financial advisor really helps the situation, because they can help work with you on your numbers and what your life goals are, and help you decide what your monthly budget should be.
Yeah, and a lot of the clients that call us, this is for context for the people who are in the industry on the call today, they really just kind of fly by the seat of their pants. So they say, well, I'm paying this much in rent, so I want my payments to be the same, or I'm comfortable, with another $500. But they look at everything in a vacuum, right? They look only at your housing payment. Well, when you own, let's say it's a single family house, if something goes wrong, it's not like renting where you call the landlord to fix it, right? So you need to have some extra money left over in case the roof, starts to leak. You'll want to fix that pretty much right away. You won't want to let me save over time, and over 6 months, I'll be able to fix it, when by then the roof is already fully caved in, right? So you have to prepare.
On the flip side of that, a mortgage payment, if you're itemizing your deductions, a mortgage payment for the interest is usually tax deductible. So you can't I think those are two different sides of the same coin, but you can't say that, oh, I want my mortgage payment to be my rent payment, right? You might want it less to save money for, like you're saying, repairs and things like that. On the other hand, you may be able to have it be more than that, in order to include, when you look at the tax deductibility, that it's effectively the same amount coming out of your account at the end of the year. So
yeah, that one will defer to the accountant, since it depends on itemizing deductions and all sorts of other things. But you're right, there are definitely some tax benefits, and it might mean that you might get a larger return at the end of the year. You just want to make sure you can afford the ongoing monthly payment in the meantime. That's the most critical. And also, like, again, how much money should you leave after closing? If you're moving from, a 1 or 2 bedroom apartment with friends, and you're moving into a single family house, you probably need a lot of furniture, to fill that place. You don't want to buy a house and leave 2/3 of it empty, because you bought too expensive of a house, or you put too much down, or whatever. And that's where, as you know, Gabi, I'm speaking to the audience here, we're big proponents of having a financial advisor on your advisory team, along with other people that you will need potentially before, but definitely after your transaction, to make sure that you're not just buying this property, but you're protecting it in all different ways, whether it be estate planning or life insurance, disability insurance, things like that. So that's a topic for another time, but that's something that we're big proponents of. And I think there's sometimes a difference. There is usually a difference between how much, as you alluded to, how much somebody can qualify for versus how much, what their budget really should be, right? You hope, and we hope that our clients who call us are in this situation where they can qualify for more, because banks are still very lenient as far as how much they'll allow you to spend. So in some cases, up to 50 to 55% of your gross income, or if you're self-employed, your net income. That's a really high number when you figure, in certain states, not all, but you're getting taxed pretty heavily at the federal and potentially state level. So you're going to lose a big chunk of whatever's left over. So oftentimes finding that sweet spot with your budget is really, really important, and not just to understand what the maximum is you can qualify for, but I think more importantly, what your comfort level is with your budget. And if you're fortunate and smart enough to work with a financial advisor to help you determine that number based on lots of factors, the global picture, how much you're setting aside for retirement was a great example you gave, Gabi. I think you have a lot more context, and again, come into these decisions with more confidence and ability to make quick decisions, which is really critical in real estate, because a lot of people see these properties come and they're like, oh, I like it. Let me start figuring all these things out now. And then by the time you know it, the property's gone, especially in a competitive market like we're in. But the qualifications are also an important factor, right? So some people think, I'll give the example of someone who's self-employed, where very common, I always say if I had a nickel for every time somebody said this to me, but I'd be retired, but my tax returns don't show my true income. So some people who are self-employed may feel confident that they can afford more than they can actually qualify for. So it's important to understand both. The best thing that a first-time homebuyer can do is to get a proper pre-approval. So a lot of banks, and especially those that operate primarily online, will like to go on and do, for example, an online pre-approval or pre-qualification, or whatever they refer to it as, where you just enter some data into their system and it says, okay, you're pre-qualified or pre-approved for a certain amount. And I don't want to mention specific bank names that do this, but there are several of them. The problem is that it's based on whatever you as the user input. So if you're self-employed, I would guess that very few, if anybody who's self-employed, knows exactly how an underwriter looks at your self-employed income, other than maybe that it's net income. But there's all sorts of adjustments that underwriters make, whether it be depreciation or other factors that can change the bottom line number. But you really need a proper pre-approval, which absolutely should require the standard documentation, pay stubs if you're on salary, bank statements to show how much assets you have, running a credit report. We actually, at the pre-approval stage now, can run soft credit reports to avoid the credit inquiries that people are really concerned about. But if you are concerned about that, watch our previous episode where we interviewed a credit expert who basically debunked the idea that inquiries really actually matter. But that's a side note. But just getting pre-approved the right way with all of that documentation is really critical, because again, then you're not guessing that you're pre-approved and that transaction will actually close. You have the utmost confidence. And there's actually a way, Gabi, I'll turn this over to you, where you can take it even a step further. So why don't you talk about that one?
About
beyond pre-approval, like a pre-underwrite.
So one of the things that we offer is, you can do the standard pre-approval, which is great, and I think it's kind of a gold standard, and it's what everybody should at least be doing. But we have another program where we're able to actually pre-underwrite you. You don't have to have a property in mind, but we get clients actually go through the underwriting process and have a commitment letter, so that they are in a much better situation where they've gone through that full step. They've had an underwriter already look at their documentation and say, okay, we have a real commitment letter. What's left is getting the actual property. So it's the best way to get you as far possible in the process, and have you have that confidence that you will get to the closing table without actually closing, but you can do that without having that property first.
Right. And I think the important part of that is that you can make a stronger offer with that in hand.
Right.
Because it shows that not only does your lender kind of think that you're going to be okay, but now they have an underwriter who is the, a decision maker on whether that loan gets approved, actually confirming it in writing. So it's a little more intensive. You do a little bit more legwork up front. But if we're talking about ways to give yourself an advantage over other potential bidders, which is the best thing you can do, anything you can do to differentiate yourself, whether it be that, whether it be larger down payment, whatever it may be, to put yourself in the best possible light with the seller. The seller will be happy with that. Your agent will be happy you did those things. And we invest in our clients to be able to give them that benefit up front, because it is a fair amount of legwork to do on our end, but that's the commitment that we make to the clients who commit to us. We commit back to them. And I think that puts them in a much better situation than they would be if they were, within the pool of everyone else who has a pre-approval or a pre-qualification, or heaven forbid, an online, pre-qualification that didn't require any verification of anything. And I think one other thing you want to make sure you do is to understand where you are as far as credit goes. There are a lot of credit myths out there. We see people making big mistakes right before they call us, where they say, oh, I thought it would be better for my credit score. I'm trying to get my credit score as high as possible, and I monitored it on Credit Karma or whatever it may be. And so I went and I closed all my dormant accounts. And that's like one of the worst things you can do. It's also not a good thing to close out collection accounts or anything, like pay them off can actually reduce your credit score, as crazy as that sounds, at least in the short term. So monitoring credit and checking with us before you do anything, or with your lender or agent if they're familiar with these things, is a really also very important factor. And I think also understanding just financing in general. This is where our expertise comes in, and where that the complimentary buyer's guides that you can order on our website will help you, is understanding, okay, loan products, what are the different options right now with a higher rate environment where rates are expected to come down. Maybe an ARM product will give you a lower monthly payment to help you buy within the range that you want to buy in. And we can talk about the benefits and potential risks of doing that. Looking at whether it makes sense to pay points, or doing what we call a seller paid buy down, which Gabi, maybe I'll have you explain in just a minute, but looking at different ways to get your interest rates down. Understanding, for example, why larger down payments are preferred by sellers. So even if you could make a legitimate offer with 20% down, but maybe a family member is willing to gift you some money to put down 30 or 40%, it's going to make your offer stronger. And then also understanding contingencies. But Gabi, I want to turn it over to you to kind of explain what a buy down is and how that can be a useful tactic for a first-time buyer.
Sure. Yeah, I think a lot of first-time buyers, as we've been talking about this whole time, obviously interest rates are higher, and that is a point of concern. And there's a few different ways that you can kind of mitigate that. So you were talking about adjustable rate mortgages, and we could talk about all of those, the pros and cons of taking an adjustable rate mortgage. But what it does is it lowers your monthly payment, obviously, for the first few years. And the end goal would be to refinance when rates do drop. Paying points is where the buyer, or sometimes the seller, can pay a fee, usually 1% of the loan amount, to lower the interest rate that the buyer is getting for the life of the loan. So when you pay points, you normally pay 1% of the loan amount. Let's say it's a $400,000 loan, you're paying $4,000 as the fee, but you're going to lower the interest rate about 0.25% for the life of the loan. Normally, when you're in a lower interest rate environment, that makes sense because you're planning on keeping that mortgage for a decent amount of time. The math usually works out that by paying that 1% fee, that $4,000, the monthly savings equals that $4,000, your break even point is usually within about 4 to 5 years. So if you're going to be having this loan or you're going to be in the property for 4 to 5 years, it would make sense to pay those points. Because we're in this environment where most likely you're going to be refinancing within the next few years once rates drop, it doesn't usually benefit if the buyer is going to be the one paying the points, right? If the seller agrees to pay it as part of the negotiation, sure, why not lower your monthly payment? But it doesn't usually make sense for the buyer to invest in it because, like like we're projecting, or what the economists are projecting, rates are probably going to be lower within those 4 to 5 years. It doesn't make sense for that initial investment for the savings that you're going to make over the few years before the refinance period. But a buy down is something that I think makes a lot of sense. And what that is where the seller pays, and we'll take a 2-to-1 buy down, and I'll go through some numbers, but we don't have to get caught up on it. But basically, the seller can pay a fee equivalent to about 2.5% of the loan amount, and the buyer saves 2% on their interest rate in the first year, 1% in the second year, and then it goes up to the regular interest rate for the third year and going on after that. So it's a great way for the first 2 years for the buyer to save a ton of money by having the seller pay this fee. You drop, let's say rates are at 7%. Your rate would be 5% in the first year, 6% in the second, and then 7% going on. And again, the idea,
and hopefully a refi within that.
And then and the idea
point
is that you're going to be refinancing within those, within 2 years, or even during the third year when you cap out at that, 7% interest rate. But the math works. I mean, it's incredible that the savings that you have in those first 2 years of having the lower interest rate can be as much as saving, $50,000 to $100,000 in the purchase price. So it would be as if, or equivalent to, having a purchase price at $50,000 to $100,000 less by doing that buy down up front. So it's a way for the seller to still get their purchase price that they want, the higher purchase price, but for the buyer to have the effects of a major reduction in the purchase price. So I think it's a great way, especially nowadays, for the seller to, again, maintain their higher purchase price, but for the buyer to be able to save a ton in those first 2 years until the opportunity of refinancing comes around.
Right. And it is a coincidence, but that refi opportunity is expected to happen within roughly 2 to 3 years. So it's possible you might never actually pay market rates if you do something like this. Now, the challenge will be negotiating this with the seller and getting them to agree. But sometimes what you can do is, let's say you agree to a price of, I'm just using an example, $500,000, right? And you're taking a $400,000 loan. That buy down will cost roughly $10,000, give or take. And so what you can do is you can set the price at $510 and build in the $10,000 that you use for the buy down to take advantage of that benefit. One of the cool perks of this is that in the event that you refinance before the buy down is complete, before the market rate goes back up to the current rate, that the full rate, let's just call it the 7% in the example you gave, as the buyer, you get to keep that money. They give it back to you. So any excess that's left over comes back to you as the buyer, which is pretty cool. And then the last thing we wanted to touch on as far as educating yourself is contingencies. So a lot of people talk about these contingencies. What are they? So basically a contingency is like a contractual protection in case something goes wrong with the loan, with the appraisal, whatever it may be. And there's different ones. There's an inspection contingency where you get to now, and different markets like New York, inspections are done before you sign the contract, other markets done after, but the concept is the same. So an inspection contingency basically protects you in the event that you find something like a problem with a foundation or something like that, or a leak or mold or something that, a fireplace falling down. And I've dealt with pretty much all of these things. I'm having some horror stories pop into my mind about things that I've dealt with. But with an inspection contingency, you have the ability to back out of a transaction if the inspection doesn't come out well, or the ability to negotiate for credits toward repairs of those things. There's a mortgage contingency, which means that if for some reason you can't get your mortgage, whether it be, you know, something with your financial qualifications, even though you were pre-approved. This should never happen if you get pre-underwritten or even pre-approved by us. But it does happen with other lenders, and I'm sure some of the agents on the call today would be able to share some horror stories about how that happened. But the mortgage contingency protects you in the event that you can't get a mortgage for any reason. Some sellers don't like to accept those, right? Because they want the responsibility to be on you to buy the home. If they're going to choose your offer, they want you to waive that mortgage contingency. There's also an appraisal contingency. So what happens if you're buying for $500,000 and your appraisal comes in at 450? Do you have contractual protection on that, or do you need to be able to, do you have to waive that in order to get an accepted offer? And we have some cool programs where we can actually guarantee the value. We can do an automated valuation and actually guarantee you a value up to a certain amount. And in the event that the eventual appraisal that we still do on that loan comes in lower, it's on us to make up the difference because of that value assurance that we've given. So that's a really cool program that for the agents on the call, if you want to talk more about that, let us know. And then you have something called a funding contingency, which is probably the hardest one to get. That means basically all the way through funding, no matter what goes wrong, if you can't get funding or your bank, you know, goes belly up the day before you're closing and they never wire the funds to the closing agent, that you're protected and it's not on the seller. They can't really do anything. They have to return your escrow deposit. So there's different contingencies, but you know, looking at things globally, I think the big picture that we're trying to get across here is you need to, as a home buyer, as a first-time home buyer, you need to know about all these things ahead of time. You need to know what your priorities are to buy. You need to know your budget. You need to know what contingencies you're willing or unwilling to waive. And you'll make your agent very happy if you come to the table, so to speak, with all of these decisions pretty much already made, just because you're educated on them up front. So I think the big picture thing is to just understand all the nuances, as many as you can. Our team is more than happy to provide resources for you and a complimentary copy of the buyer's guide and other resources that can help you get educated, but spend the time to understand what you're doing. This is going to become, as a first-time buyer, almost for sure the biggest investment you've ever made. And a lot of people we see jumping into it kind of willy-nilly, or they try to figure it out on the fly, and they make either slow decisions, which can derail a transaction, or they just don't feel confident. And that sense of confidence when you're going into a major purchase, in my opinion, is really, really important. So, Gabi, I think we're going to wrap it up here, but I appreciate you joining me today to share this insight. Again, for those of you who are watching this live, we have a ton of resources to be able to offer, a lot of educational information on our YouTube channel, the podcast, the On the Mark podcast, and Financial Forum, which you're participating in today, has some amazing resources, more in-depth information about buy downs and other things that we've talked about today. So please go to our website, markmyman.com, and you can explore all of those resources that we have. Our YouTube page has a ton of videos, and we're always adding more and more. And again, as a reminder, for those of you who are on social media, please share this event with others in your network. We will have a recorded version of it. It will be on our podcast within a few days. And if you share it and tag us in it, we will enter you to win that $25 Amazon gift card. So thank you all for joining us today. And if you have any questions, you know where to find us. markmyman.com is a great hub for everything you need about us. So we'll see you next time, and have a great day.